Have you ever looked at a chart and thought, nothing is happening here? Price is just moving sideways. There's no strong trend, no obvious opportunity. So most traders just move on. But what if that boring range is actually where the next major move is being prepared? What if, while most traders are losing interest, someone is quietly building a position? This is where accumulation comes in.
Accumulation is a period where large market participants gradually build long positions before a potential bullish move. They don't just buy everything at once, because if they did, their own buying could push price higher way too quickly, and then they'd have to pay higher prices for the rest of their position. So instead, they gradually execute their orders over time, often while price stays inside a relatively quiet trading range. And that's exactly why accumulation can be so easy to miss.
Why does accumulation happen? There's no massive breakout, no obvious bullish trend. Sometimes the market can even look slightly bearish. But underneath all that movement, the balance between buyers and sellers may be starting to change. Think about it this way. Imagine you want to buy a huge amount of an asset. If you suddenly place one massive buy order, price could jump immediately. Now you're forced to pay higher prices for the rest of your position. Not exactly what you want. So instead, you want sellers to keep coming into the market. Every time someone sells, there's someone on the other side willing to buy. And that's one reason accumulation can develop slowly.
Not every range is accumulation. But here's where things get interesting. Not every sideways market is accumulation, and this is one of the biggest mistakes traders make. They see a range, they see support, and immediately think smart money is accumulating. Not necessarily. A sideways market could simply mean buyers and sellers are balanced. It could be a pause before another move lower, or it could eventually break in a completely different direction. So how do we tell the difference? We need clues.
Clues of accumulation. Clue number 1, repeated support. One of the first things you want to watch is how price behaves around an important support level. Imagine price keeps dropping into the same area. But every time it gets there, buyers step in and push price back up. Then price comes back again, and buyers show up again. When you see this happening repeatedly, something may be changing. The market is having a harder and harder time moving lower. And that's important. Because earlier in the downtrend, selling pressure may have been strong enough to push price down aggressively. But now, that same kind of selling is producing less and less downside. That's something you definitely want to pay attention to.
Clue number 2, false breakdown. Now, let's make things a little more interesting. Sometimes price doesn't just test support, it actually breaks below it. And this is where a lot of retail traders get trapped. Price drops below an obvious support level. Traders see the breakdown and think, the market is going lower. Some close their long positions, others jump into short trades, and stop losses sitting below support start getting triggered. But then, price suddenly comes back above the level. The breakdown fails. This is what we call a false breakdown. And by itself, a false breakdown doesn't prove that accumulation is happening. But when you see it inside a larger accumulation structure, it becomes much more interesting. Because that failed breakdown tells us something. Sellers had a chance to push price lower, but they couldn't keep it there. And that's important information.
Clue number 3, weaker selling pressure.
This is one of the most important clues. Don't just look at whether sellers are still present. Look at what their selling is actually doing to price. Imagine that earlier in the market, one strong wave of selling pushed price down 100 points. But later, a similar amount of selling only moves price 20 or 30 points before buyers step in. The sellers are still there, but their impact is getting weaker. That's what you want to notice. The market simply isn't reacting to selling the way it used to. This can be a sign that supply is being absorbed.
Think of it like pouring water into a sponge. At first, the sponge absorbs everything, but eventually it gets saturated. Something similar can happen with supply. As buying absorbs the available selling pressure, there may eventually be less supply standing in the way of higher prices. And when demand finally becomes stronger than supply, price can start moving much more aggressively. That's why some of the strongest rallies begin after periods that looked completely boring. Most traders ignore these periods because nothing is happening. But sometimes, the most important part of the move is happening before the move itself. So instead of asking, why isn't price moving? Ask yourself, what's changing while price isn't moving? That one question can completely change the way you look at a chart.
From identification to trading, how do you trade accumulation? Now, let's say you found a range that shows several of these characteristics: repeated support, failed breakdowns, and weakening selling pressure. The next question is obvious. How do you actually trade it? And here's the first thing you need to understand. Accumulation is not a buy signal. It's a market condition. It tells you that a bullish move may be developing, but it doesn't tell you exactly when to enter. For that, you need confirmation. Wyckoff, understanding accumulation through price behavior. One of the most useful frameworks for understanding this process comes from Richard Wyckoff. Wyckoff's basic idea was that large participants can sometimes leave clues through price behavior. They don't exactly tell us what they're doing, but we can sometimes get an idea by watching how price reacts to supply and demand. One event traders often look for is called a spring.
Spring, the failed breakdown. A spring happens when price briefly moves below support, making it look like the market is breaking down. But instead of continuing lower, price quickly reverses back into the range. At first, it looks bearish, but the fact that price couldn't continue lower can give us some important information. It tells us that sellers had a chance to push price lower, but they failed. However, even a spring is not automatically a buy signal. We still want confirmation. Spring, the failed breakdown. A spring happens when price briefly moves below support, making it look like the market is breaking down. But instead of continuing lower, price quickly reverses back into the range. At first, it looks bearish, but the fact that price couldn't continue lower can give us some important information. It tells us that sellers had a chance to push price lower, but they failed. However, even a spring is not automatically a buy signal. We still want confirmation.
Sign of strength, SOS, confirmation of buyer control. And that's where another important concept comes in. This is where the market starts showing clearer evidence that buyers are taking control. Price pushes through resistance with stronger momentum. Instead of getting rejected right away, buyers are able to keep control. This is the kind of behavior many traders want to see before considering a long position. Why? Because instead of trying to guess the exact bottom, you're waiting for the market to show you that it can actually move higher. Yes, you might miss the first part of the move, but that's completely fine. You don't need to catch the exact bottom. You need a setup where the potential reward makes sense compared to the risk. The retest. Previous resistance becomes support. After a strong breakout, price may eventually come back and test the previous resistance. And if that old resistance now acts as support and buyers step in again, that retest can give you another potential entry. Risk management. When the accumulation idea fails. But remember, even a beautiful accumulation pattern can fail. Nothing in trading is guaranteed. That's why risk management matters. Your stop loss should be placed at a level where your original idea is no longer valid. If price falls back below an important support area and stays there, you may simply have been wrong, and that's okay. Professional traders aren't trying to eliminate losses. They're trying to keep those losses under control. If you found this video helpful, make sure to like the video and subscribe to the channel for more practical trading education. Thanks for watching. See you in the next one.